Are you max funding your traditional retirement account at work? While you're certainly saving the right amount of money, the location of your savings can create a whole host of tax problems down the line. And today I'm going to share the 5 challenges you face and the 8 ways to help defuse your ticking tax time bomb. There are a lot of financial gurus on YouTube, but are you listening to a qualified professional who has actually helped somebody else retire successfully? I have spent the last decade of my life not only studying finance, but managing millions of dollars for our clients who are approaching, newly, and in retirement. I've seen the difference between clients who have tax diversification versus clients who don't. And today I'm going to share why only contributing to your pre-tax account will hurt you in retirement. Before I get started though, please be sure to like and subscribe to our channel. This helps us get this information out to as many people as possible, so thank you in advance. As a hardworking, high net worth individual, you're likely to have a significant portion of your wealth in pre-tax retirement accounts. You're doing the right thing by maxing out your retirement plan, but contributing solely to the pre-tax account can seriously hurt you in retirement. Your main focus should be on lifetime wealth accumulation. And in order to accomplish this, your taxes need to be planned not on a year in, year out basis, but on a lifetime basis. Your advisor needs to balance the benefit of deferring taxes now against the liabilities those accounts will create later in retirement. You might believe that you're currently in the highest possible tax bracket, so deferring as much as possible now is the best idea. However, this approach is short-sighted. Future tax rates are not guaranteed, and if we look at past tax brackets and rates, we know that we're currently in the lowest tax regime in history. Not only that, but there are stiff income penalties you'll face in retirement, the Medicare IRMAA surcharge being the most significant. So let's review the 5 challenges that those who are maxing out their pre-retirement accounts face today. Number 1, current low tax rates. As mentioned earlier, current tax rates are historically low. With our government in a tax and spend mode, we are all vulnerable to higher future tax rates. In fact, the Tax Cuts and Jobs Act will sunset in 2025. Taxes are set to increase without any action by Congress. Policy risk has increased as well. The politicization of income and estate taxes, as well as the pace of change, has accelerated. A reconciliation bill only needs a majority vote now, thereby creating challenges around planning. Number 2, catch-up contributions hurt. Your additional pre-tax retirement contributions hurt, not help. As you contribute catch-up amounts into your pre-tax account, your tax liability continues to grow with the growth of the stock market, creating a perfect storm. For example, let's say that upon retirement, you have a 401k worth $3 million and you're in the 22% tax bracket. Well, how much of your 401k do you actually own? Well, only 78%, because every dollar you withdraw from your account will be taxed as ordinary income. So instead of picturing $3 million, you should be picturing a little over $2.3 million. Whereas if you had a $3 million Roth 401k, all $3 million of that account would be yours. But Julia, if I had a $3 million Roth 401k, I wouldn't have received all of the tax deductions during my working years. And yes, that is correct. But let's do some rough math to better understand this concept. Let's say that you're 30 years old and you have 35 years until retirement. You're in the 22% tax bracket and you will contribute $19,500 per year to your Roth 401k. So you won't get the tax savings of $4,290 per year. Over 35 years, that's a missed savings of $150,150. But wait a minute. Now you have a 401k that's actually worth $3,174,772, and it's all tax-free. If you had instead contributed to the pre-tax account, you would have saved that over $150,000 until retirement. However, now you or your children are due to pay 22% on the entire balance over yours and their lifetime, which on over $3.1 million is almost $700,000. This is 4.65 times more in tax by failing to plan ahead. And we're not even including the Medicare IRMAA surcharges. You see, most people are present-oriented, meaning that they're only thinking about how to save in tax this year as opposed to over their lifetimes. This is why working with a great financial advisor who is future-oriented is so important. Number 3, income-related Medicare adjusted amount. Medicare IRMAA surcharges are a tax, and the costs add up. When you join Medicare, Medicare looks at your modified adjusted gross income from 2 years ago to determine your Medicare Part B and Part D premium rates. If your income is over the base tier, you will pay more, and in some cases, triple the base premium. Looking at an extreme example, a wealthy couple could pay $1.5 million in Medicare means testing surcharges between the ages of 65 and 90. And this is on top of base charges of over $850,000 over that same time frame. If the lion's share of your investments are pre-tax, you will never outlive this issue. However, under certain stipulations, you may qualify to appeal these extra charges. Please see our video on this, and I'll put the link below. Number 4, the widow's penalty. When a surviving spouse moves out of the married filing joint bracket into the single tax bracket, tax rates increase by roughly 10%, but total annual Medicare payments often stay the same or increase, despite the fact that now only one person is covered instead of 2. For example, using 2023's tax brackets, if you and your spouse were pulling in taxable income of $120,000, you'd be in the 22% tax bracket. Upon one spouse's death, the remaining taxable income is $85,000, which would put you in the 12% tax bracket as a married couple. But because now you have to file as single with lower and narrower brackets, your tax bracket is back to 22%, even though there's only one of you. So you get less income but pay the same percentage in taxes. Number 5, the Secure Act. The Secure Act requires a 10-year distribution period instead of the lifetime stretch that was previously allowed. Instead of having to take distributions over their lifetime, your heirs now must take taxable required minimum distributions over just 10 years. This pushes them into high tax brackets, likely during their highest earning years, thus diminishing your legacy. So what strategies can help? The following 8 are ones that we use to minimize lifetime taxes for our clients. Not every client can or will use all of these strategies, but we collaborate to decide which ones fit for each client. Number 1, review employer benefit plans and strongly consider Roth 401ks for all future contributions. Employer benefit plans are full of great investment options, such as Roth 401ks, after-tax accounts, stock option plans, and deferred compensation plans. If you've already built up a large pre-tax retirement account, it's crucial that you diversify your tax landscape to start growing a tax-free bucket of money for your future and for your heirs' future. Number 2, Roth conversions. In our practice, we use sophisticated software to determine the ideal amount of pre-tax money to convert to Roths each year to minimize lifetime taxes. Once it comes time to withdraw income in retirement, you'll be so grateful that you have a tax-free option. Roth accounts also help to keep taxable income down, which increases other deductions and decreases the Medicare IRMAA surcharges, among other benefits. Now, be aware that in order to complete Roth conversions, you must have enough cash outside of retirement accounts to pay the extra taxes each year. Number 3, backdoor Roth conversions. Make too much to directly contribute to a Roth IRA? As long as you meet the criteria, you and your spouse can invest the maximum amount in a backdoor Roth IRA each year to grow your tax-free bucket of money. Number 4, health savings accounts. If you know me, you know that I love a health savings account. So much so that I did a whole video on it, and I'll put the link below. You can invest up to $7,300 per year for a family in this triple tax exempt super account that can be used tax-free for health expenses and taxably for anything once you turn age 65. Number 5, tax loss harvesting and gain harvesting. In brokerage accounts, the timely selling of securities at a loss to offset the amount of capital gains owed is an important practice to limit short-term capital gains and to preserve your portfolio while reducing taxes. Number 6, asset location. Investing is not all about asset allocation, but about asset location as well. For example, placing slow growth or income yielding investments in tax-deferred accounts and faster growth investments into Roths allows the investments to grow as tax efficiently as possible. Number 7, beat conventional wisdom. Conventional wisdom states that you should draw income from your taxable investments first, followed by pre-tax, followed by Roth IRAs. But at URS, we beat conventional wisdom by distributing money upon retirement from pre-tax accounts first, as you were in a lower tax bracket during the lowest tax rates in history. Filling up your bucket or tax bracket with pre-tax withdrawals is one way to make the most of your lower tax bracket. Number 8, qualified charitable distributions. If you're charitably inclined and at least 70 and a half years old, you can donate up to $100,000 per year to an eligible charity directly from your pre-tax retirement account, using what's called a qualified charitable distribution. The donation is not taxable to you as it transfers directly to the charity, thus preventing you from being thrust into a higher tax bracket, plus it can prevent phase-outs of other tax deductions. It is the most tax-efficient way to donate money. Okay, I hope that this video was helpful and pushes you to reconsider your current lifetime tax strategy. We'd love to hear from you, so if you have questions or comments, please leave them below, and I'll see you next time.